They're selling them because they need cash to lend to their own banks to bail out dollar borrowers who can't pay their debts. This is part of a global dollar shortage. And one by one, it's taking various economies into recession. So again, you got to go behind the curtain, say, hey, what's going on backstage in the Eurodollar market? And what you see there is monetary contraction, a global dollar shortage. And then people say, well, wait a second, how could there be a dollar shortage? The Fed printed all this money. But I just explained the money the Fed printed went back to the Fed. It didn't go anywhere. The real money in the system is created by the commercial banks in the Eurodollar market. They're contracting for their own reasons. Mainly, they're afraid of credit. This goes back to your point about, are we heading to stage 2 of the banking crisis? I think the answer is yes, but they're very credit conscious. The time bomb, or maybe landmine is a better word, the landmine this time are not home mortgages as it was in 2007, because that actually, it's hard to get a mortgage, at least in the United States. They've reformed.
In this insightful snippet from finance expert Jim Rickards, we delve into the complexities of the global economic landscape. With data indicating recessions in major economies like the UK, Germany, and Japan, and a perceptible slowdown in China, Rickards suggests that the traditional levers of monetary policy, such as those utilized by the Fed, are proving less impactful. Instead, he points to the euro-dollar market and commercial banking sector as crucial indicators. Rickards highlights a global dollar shortage, driven by banks contracting their balance sheets and becoming increasingly risk-averse, particularly in the face of potential crises in commercial real estate.
The Fed is almost irrelevant, almost completely irrelevant. If you want to know what to look at, say, hey, I want to understand the international monetary system. I want to see if we're possibly heading into recession. By the way, the UK is in recession now, right now, not forecast now. UK is in recession. Germany's in recession. Japan's in recession. EU as a whole is in recession. They're not severe. They haven't been that long, but they are all in recession. Germany, the worst of the lot. China is slowing down perceptibly, and I'm sure you feel that in Australia because that's your largest export market. China they've tried everything. They cut rates, monetary ease, stimulus programs, government spending. None of it's working. They're just chugging along, but slowing down, running out of momentum. And again, that will have an impact on Australia. We'll come back to the U.S. a little bit because I know I want to talk about U.S. GDP. But the point is, if you really want to understand that, you have to look at commercial banks. See, when the Fed prints money, I said it doesn't matter. Here's why. How does the Fed print money? What they do is they call the primary dealers, which are the big banks, Goldman, Wells Fargo, Citi, et cetera, and they buy bonds or notes or treasury bills. So they'll call Goldman, say, offer me 5-year notes. Goldman will offer them, they'll say, done. Goldman delivers the notes, and then the Fed pays them. When the Fed pays Goldman Sachs in that example, that money comes out of thin air, and that expands M0, which is base money. Call it money printing if you like. Okay, what does Goldman do with the money? They give it back to the Fed in the form of excess reserves. They deposit it with the Fed in the reserve account, and it's excess reserves. And by the way, the Fed pays interest on excess reserves, IOER. They pay interest on excess reserves. So if you're Goldman and you're leveraged and you got some money at the Fed, you're making money on it. The money doesn't go anywhere, Shay. It's not lent. It's not spent. It doesn't affect consumers. It's not in the real economy. It's not being used to finance infrastructure or anything else. That money the Fed prints it and gives it to the dealer, and the dealer gives it back to the Fed. And that's how they expand their balance sheet. Now, right now, the opposite is happening. But my point is going back to QE, and I lost count. It was QE. I kept track up to QE4, and then it was QE5, QE6. And then they did one QE, and they said, don't call it QE. It's like, okay, it's QE7, whatever. But none of that money made it into the real economy. It was just recycled in the form of banks putting money on deposit at the Fed and the money basically being sterilized. So where does the money creation come from that does affect the economy, that does stimulate the economy? It's from the commercial banks, and it's in the Eurodollar market. So what you have to ask yourself is, are the banks expanding their balance sheet? Are the banks lending money? Are the banks accepting various forms of collateral so that people can take leveraged positions? Forget the Fed. Look at the banks and look behind the curtain, not even at your Australian or U.S. domestic deposits. Look at the Eurodollar market, which is very opaque, very hard to get good data on it. But I can tell you what's going on there. Banks are contracting their balance sheet. In other words, where the real money, this is M1 we're talking about, which are basically bank deposits. That is contracting. Banks are reducing their balance sheet. They're more and more strict on collateral. Forget mortgages, forget corporates, forget even AA rated bonds, even 30-year bonds. All they want are treasury bills. They want the best form of collateral, which are treasury bills, 1 month bills, 6 month bills, even a year is kind of long for this purpose. So they only want the most pristine, super liquid, least volatile type of collateral, which are very short-term treasury bills. Pardon me, and they're reducing their balance sheet. So there is monetary tightening going on, but it's not being led by the Fed is doing it, but the Fed's not having much of an impact. What is having an impact is the commercial banking system, the Eurodollar market. And this explains another phenomenon that people get wrong, which is they look at every, I forget if it's monthly or quarterly. I think it's quarterly, but fairly often. The Treasury publishes what they call the TIC report, TIC. And this is a report that shows foreign holdings, central bank holdings of U.S. Treasury securities. That's what it shows. And so if you look at China, you'll see a reduction. You'll see that China's holdings of U.S. Treasury securities are going down. So people go, aha, the Chinese, they don't want treasuries. They're dumping their treasuries. They're getting out of treasuries. This is the end of the treasury markets. No, it's the exact opposite. China is desperate for dollars. They cannot get dollars from the banks, particularly Japanese banks. So they're selling treasuries, not because they don't want the treasuries. They'd love to have more. They're selling them because they need cash to lend to their own banks to bail out dollar borrowers who can't pay their debts. This is part of a global dollar shortage. And one by one, it's taking various economies into recession. So again, you got to go behind the curtain, say, hey, what's going on backstage in the Eurodollar market? And what you see there is monetary contraction, a global dollar shortage. And then people say, well, wait a second. How could there be a dollar shortage? The Fed printed all this money. But I just explained the money the Fed printed went back to the Fed. It didn't go anywhere. The real money in the system is created by the commercial banks in the Eurodollar market. They're contracting for their own reasons. Mainly, they're afraid of credit. This goes back to your point about, are we heading to stage 2 of the banking crisis? I think the answer is yes, but they're very credit conscious. The time bomb, or maybe landmine is a better word, the landmine this time are not home mortgages as it was in 2007, because that actually, it's hard to get a mortgage, at least in the United States. They've reformed everything. It's like, the no doc, low doc, no down payment, no appraisal mortgages, forget it. You need 20% down or more. You need a bona fide appraisal, high, good credit standing. You need a lot, income, all verified, etc. So it's actually hard to get a mortgage. So that's not the problem. The problem is commercial real estate. And this is a legacy of a couple things.
Continuing our exploration into the economic insights provided by Jim Rickards, we now delve into the looming crisis in commercial real estate. As the pandemic catalyzed a seismic shift towards remote work, leading to a surplus of empty office spaces coupled with a construction boom fueled by low interest rates, the stage is set for a collapse in this sector. Rickards predicts a prolonged impact, akin to the aftermath of the Great Depression, with social changes lasting decades. With buildings remaining unleased and construction loans nearing maturity, a domino effect ensues, potentially triggering a fire sale scenario and severe write-downs across the banking sector.
Number one, the whole work from home movement, which everyone said you can't do it. Well, we were forced to do it by governments, at least. This was around the world. The U.S. was just as bad. Canada was probably worse in their own way. The Freedom Truckers, et cetera. I gave them money. I'm surprised they allowed me across the border, but I have a family. I have family in Montreal, so I had a good excuse. That work from home thing actually worked. We're, I'm not in Australia, you're not in the United States, but we're doing a face-to-face interview. People got used to Zoom, they got used to teleconferencing, et cetera. And a lot of people never went back to the office. And then a lot of employers allowed it. I mean, the federal government, all those buildings in Washington, D.C., they're 2/3 empty. Everyone's working from home in Virginia. So that's by itself would have killed commercial real estate. But coming out of the pandemic, when interest rates were quite low at the time, there was a building boom. The developer said, hey, interest rates are 1% or 1.5% or 2 or whatever. Get me a construction loan. Let's put up a skyscraper, et cetera. So you had a building boom. At the same time, you had a cultural shift that, in my view, will last for 30 years. And I said that in my book, The New Great Depression. I said, the pandemic may be over, but the pandemic effects, the social changes will last for 30 years, as was the case in the Great Depression. When you have a social shock that significant, you don't get over it in 2 years. So between work from home and the building boom, now there's a glut of commercial real estate, and construction loans are not long-term mortgages. They're like 3-year loans. And you have to, basically the idea is you get a 3-year construction loan, then you lease up the building, and then you get a long-term mortgage, or you get a syndicate of investors and pay off the construction loan and, live off the rents. But they're at the point where they can't pay off the construction loans because the buildings are not leased up. Maybe in Dubai, but not in New York, and I doubt it's any different in Melbourne or Sydney. So we're looking at a commercial real estate collapse. Now, there's a game that goes on where the banks, they just hold it on, the lenders hold it on their books. If you don't sell it and you don't get it appraised, an accountant will let you keep it on your books at, whatever the cost was, the historic value. But what happens if one bank gets in distress? They don't want to sell the buildings, but they have to. Or they don't want to sell the mortgages or loans, but they have to because they're in distress. It's a fire sale. Well, that's when you see real pricing. That's when you see prices down 40%, 50%. But the impact of that on all the other banks is now the accountants say, hey, that bank across the street, they just took a $5 billion write-off on their commercial real estate portfolio. What about you? You can't tell us that all this stuff is worth par. And then the write-downs begin, and then the distress begins, then the fire sales begin, and then that's when the whole system starts to implode.
As we conclude, let's revisit the key insights from Jim Rickards' analysis. We've explored recessions in major economies and the importance of looking beyond traditional indicators. Rickards highlights the significance of the commercial banking sector and the euro-dollar market. Additionally, we've delved into the looming crisis in commercial real estate. Thanks for watching. Remember to subscribe, like, and share your thoughts in the comments below.